Ladies and gentlemen of the crypto space, we're live on a Monday, March 23rd at 11:34 a.m. And this is not what I wanted to open the stream with. This is what I want to open the stream with. So, this is a topic we talk about a lot, but this is big data. Now, it's not often, and we haven't had big data in a little bit of time. It's been calm on big data. Um, and what's most important about my streams is we don't open. Let's restart that. We are a cryptocurrency centric content stream, but we don't need to talk about cryptocurrency pricing because that is the last thing you want to look at. You don't want to look at the Bitcoin chart to understand what the Bitcoin chart is doing. The first thing I look at, uh, aside from market close or shit that happens like this, when I wake up in the morning is what's the dollar doing or what the bond market is doing or what the volatility of the global money market is doing. Money is bonds. But and that tells us completely indirectly in three charts, more or less high level, what cryptocurrency pricing is doing. And that is a very simplified way to look at the entire cryptocurrency space. So there's big takeaways, and I like to talk about how these takeaways play into me understanding the crypto market. So, what's the relationship? So, this chart tells us the volatility of money. So, volatility is a psychological phenomenon. It's a numerical phenomena, but it plays directly into psychology. So, when you see the volatility of money explode like this, it shuts everything down. All the deals that are basically on the table, especially from banks coming out of the underwriters and the promotional material what underwriters at a bank would give to the marketing department. All that shit gets put on hold. Everything they say stop because the volatility of money just exploded. Therefore, pricing of underlying money is changing rapidly. And that plays into all the calculations, all the discounts, all the offers, all the bonuses, everything. So when you see a spike like this on a Friday afternoon, some shit is going down. And this is the largest move spike since March of 2023 from a monthly candle perspective. It's a 55% rip in the move spike, 38 points up to 108, punching the monthly 50 SMA. The last time we saw a spike like this, as I said, was March of 2023. And what was occurring in March of 2023? The United States banking system was failing. This was Silicon Valley Bank. And this is what brought on the BTFP and four letter or whatever letter acronyms out of the Federal Reserve, particularly to calm markets, calm the volatility. If the banks were forced to sell and liquidate their assets, that would have caused other banks to liquidate their assets, and it would have rippled through the system. And that's exactly what the BTFP cured. Now, I'm not saying we're in that period of time. It's comparable to that period of time from a volatility perspective, but clearly we are at significantly lower levels of volatility than we were back in March of 2023. But this, from a delta perspective, is still going to induce those psychological knock on effects that occurred back then. It's just such a tremendous change in the pricing of money. It's guaranteed to produce those psychological knock ons. Now, we couple this is just further volatility. So the move spiked on Friday, and we opened today with the DXY down below 100, pulling back to basically 99, a little less than, no, this was 99, let's say, give or take. Earlier today, I saw it a little bit lower, 99.1 and change. And that is another absolutely insane psychological threshold, the 100 mark. And it's as simple as that, three digits versus two digits. So this 100 level is absolutely remarkable to stare at on a chart. So Aside from the volatility of money, which we look at in the move indicator, we have this entire region here, which is the last one, two, three, four, five, six, 7, 8, 9, 10. This is the last year, ladies and gentlemen. We're going on 1 year of the price of the dollar, which is currency, basically being indecisive. Um, Now, obviously, currency just isn't an entity unto itself. It's not that the currency is being indecisive. The pricing of currency, and even more so, the relative pricing of currency, is a manifestation of geopolitics, respective nation state politics. So it's a manifestation of everything that's going on, including the pricing of commodities, trade, um, so on and so forth. Um, but the lack of this chart making a decisive move to express directionality is just an added degree of volatility, an uncertainty component in the overall calculus. 1 year that we thought it was going like 2 months ago, the dollar was down at 95. It was going to keep going lower. It was going to break lower. It was going to start to produce lower highs and lower lows, but it didn't. It bounced back over the last 2 months, especially with the start of the war. And it punched up over 100. So this is where we are at. We're at this inflection point of volatility, not only in the pricing of money, but the relative pricing of currency. And that just leaves us in a complete state of uncertainty. This is applicable to everything, be it commodities. Look at gold, 5,500 down to 4,400. That's a monumental, historic, epic, no precedent swing in the price of gold. We see clearly that volatility priced in everything across the entire crypto space. Um, and this just gets more specific. If we look into like the 10 year, this is the actual price of money. But this is really manifested when we talk about the move indicator. We're already talking about the kind of volatility that we would see looking at this chart. This chart tells us one additional piece of information that most people don't discuss because they don't look at the pricing of money and the pricing of currency the same way I do. And I see the Treasury Department of the United States as a producer with the world as a consumer, much as a manufacturer of a good and service has consumers in a market. So the Treasury Department, from my perspective, produces a product, just like a food manufacturer has an assembly line, a manufacturing line, and they have shipping and they ship to people that pay for their products that they produce. So this, to me, this chart and this blue line kind of represents more or less what I discuss, in that the Treasury Department has produced a product over the last, this is 1,246 days, where the price is more or less unchanged. It's very comparable in pricing. And if you zoom out a little bit, in my opinion, and if we got a little bit more granular with some lines and some measurements, this is probably the longest period in modern history where the relative pricing of money has been so stable. Now, obviously, the 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 actual that this is the actual pricing. This is up at 4 and change%. That is a relatively depreciated value of money, highest interest rates we've seen since 2000, 2007, 2005 to 2007. Um, so that is so that plays into the conversation. But just as I said, the delta on the move indicator now is not the same level as March of 2023. It's that volatility that's much more interesting. So to me, it's not the comparison between now and 2005 to 2007, that's the biggest takeaway. The biggest takeaway here is that for the last 1,246 days, the relative price of 10-year US debt is very stable. So, Treasury as a producer has met the demand of the consumer almost perfectly. So, my takeaway from that, and no one else will say things like this. My takeaway from that is that Treasury has done a remarkable job facilitating coordinated efforts. This is the cynical maximalist in me. So, the global collusion between nation states at the central bank and fiscal authority level has been optimized. Treasury has not done gross things, and we know the narrative of the Treasury prints money, and that's just a quote unquote. We that's an entire couple of segues I could do there. But as a producer of debt instruments, they have met the demand of the market, and obviously that's on the backdrop of the entire stupid conversation that social media and the general public have with things like Congress's gross spending and the national debt is past $39 trillion. Yes, yes, those are secondary. Those are those are downstream conversation points, ladies and gentlemen. The primary conversation point is that the Treasury, in my opinion, is in the driver's seat as a producer of a product, and the world consumes that product. Therefore, if the market demands more treasuries, Treasury has to respond and produce to meet that demand. And then Congress has to figure out a way to spend that money. And then, because otherwise the Treasury General account may get skewed, and then people are looking at the Treasury General account, and then Congress is looking at the Treasury General account, and they're like, well, we got to spend more money. Aside from them being people, they have a fiscal responsibility, and so on and so forth. So, all of these points that I am making get all muddied and complicated and messy when you start trying to understand what I'm talking about in the context of popular social media narratives like the $39 trillion debt and Congress spends like drunken sailors. Yeah, because the world is demanding that the United States produce these instruments that the world uses as collateral, a collateralizable money, because the world uses this collateralizable money to print currency. And the world requires this currency in order to literally, first and foremost, pay interest on outstanding debt obligations. And the outstanding debt obligations have been created to create the existing currency and circulation around the world, and also facilitate growth. They need to grow the amount of currency in existence around the world, not just to pay the interest on outstanding debt, but to also generate revenues and all the shit that all the sheeple on social media talk about with regard to equities and profit, price to earnings, those types of very downstream points that I would argue. That's all downstream. The highest level macroeconomic conversation by far, ladies and gentlemen, is the price of money, the price of currency, the relative price of currency, the volatility of money, the volatility of currency, and the reality, the macroeconomic reality that money prints currency. And the most important, one of the most interesting contrarian points is that the vast majority of dollars have not been printed by the United States, by the Federal Reserve, by the Treasury Department. The vast majority of dollars in existence, ladies and gentlemen, were printed outside of the United States in what we define as the Eurodollar banking system. And that's simply, just to have a simple definition of the Eurodollar banking system, is a bank that takes in collateral, money, US debt instruments, and issues liabilities against it. And a liability is easy for a bank to create because they create it out of thin air. It's a deposit in their ledger. Banks have accounting, and that accounting is called double entry accounting, where they have assets and liabilities. So if they're taking assets in order to balance the books according to double entry accounting rules, and every country is going to have different rules, and the underwriters are going to have their requirements based on risk tolerances to respect the rules, so on and so forth, and profit and what have you. They have to print liabilities to balance the books. So that's how dollars are printed, ladies and gentlemen, in the euro dollar banking system. So if the world is demanding these money-like instruments, at some point, the amount of currency supply has to increase merely for the banks to balance their books. But it's not just the banks to balance their books, it's also the demand of the consumer of the products that the Treasury produces. So the banks, that which manifests that the banks are forced to balance their books by offering incentives to consumers, discounts, special rates, deals, bonuses. So the international community buys these money instruments, deposits them with the bank, and then the bank issues the liabilities, balances their books. The consumer gets their deposit at the bank, so they get their United States dollar currency instruments, these dollar liabilities in the eurodollar banking system, and they could spend them. And that's basically the gist of the global dollar system, the way it works in currently. It's the simplest possible explanation that I could offer. How about that? What was that? That was all right. That was about 21 minutes of a recap of how global dollars work in reality versus compare that to popular social media narratives. I think it's probably the most contrarian take I could anyone could offer, and I could come up with in 21 minutes. Hey, volatility. So what's the narrative today? The that the administration is backtracking on plans to make some attacks today, and then Iran was like, no, they didn't say anything. It's all he said, she said. It's literally all soap opera bullshit. I don't care about talk. I don't care about rhetoric. And then the social media will be like, oh, because of the he said, she said, the soap opera, the market's responding. No, the market's not responding because of the soap opera. The market's responding because of literally this print, because of this change in the relative pricing of money around the world. So the headlines come out and respond to that, and then the counter headlines come out and respond to that. But what matters is what the banks are doing and what financial actors are doing, and this basically freezes the entire system. So this gets everyone spooked, and then you get yeah, well, what's a narrative? What's a real narrative? And the real narrative is if the volatility of money is blowing out like this, excuse me, 28% on a Friday, that's interventionary territory. That's where the global collusion must intervene in the relative pricing of money to get things under control. Otherwise, the systems freeze. Otherwise, the banks aren't lending. If the banks aren't lending, that screws up all the revenue for the banks. That screws up the capacity for consumers to get the liabilities they need to pay not just debt obligations, interest on their debt obligations, but also salaries, you know, a settlement of orders. You know, the entire consuming world, manufacturers run on net terms, 30-day net, 60-day net, 90-day net. Everything runs on delayed settlement. So, and it all runs on credit. So that's more of a short-term type of credit offering by the banks rather than a long-term structured type of debt arrangement. So if you're uh, Supermarkets are different. Supermarkets lease their space, a lot of them. But let's say you're a supermarket uh, that runs like this. You have a whole lot of stuff in your supermarket, but you haven't sold it yet. So you get a relative credit from the supplier, the distributor. So the distributor fills the shelves. You run on, let's say, the net check 60 days. You have 60 days to pay the distributor. Over the next 60 days, you're going to sell oh, at least all the meats, at least all the perishable items on the outskirts of the supermarket. Everything that's the vegetables and whatnot is probably net 15, maybe net 30. Everything in the middle has maybe definitely a longer duration. Uh, um, uh, all the preserved and processed foods, all the frozen foods have a long shelf life also. But at some point, that check comes due. So that credit runs dry. So that means the stuff has to sell. And so, but when the volatility of money does stuff like this, you might not get that net 60. You might get a net 30. You might not get a net 90. You might get a net 60 or a net 30. You might not get the same deal because the bank can't issue the liabilities, or they have a different risk tolerance to issue liabilities. Uh, you can't get the credit. So it gums up the entire system, and that has a way of rippling. Once one thing gets blocked up, the next thing gets blocked up, and that rolls throughout the entire system. So when you see things like this, the Bitcoin narrative is probably forward looking. It's forward looking on intervention. So if you see a suppression, how do you now you get into potential contemplation of Fed acronyms or various programs and policies to suppress the volatility of money to increase the flow of currency and the currency creation process around the world. Again, the forward-looking type of thought experiments. And you're looking at markets as if they're forward looking. Now, obviously, like equities. So if the corp, so a corporation is relatively stable now. The volatility of money blew up on a Friday, but all of a sudden we have now the potentiality for some suppression of volatility, increased currency flow. Now, a company that's relatively okay now has the potential for access to some credit, so the growth narrative becomes forward looking or increasingly likely in a shorter time horizon. So maybe you thought the growth would come towards the end of the year, 9 months down the road, and maybe it's now 6 months because uh, w- the conversation people are thinking is some sort of intervention is likely required, which would free up credit, and that's stuff like this. So this is what caught my eye. So this is what comes out on a Monday after a volatility of money blow up on a Friday. There, you get a Fed governor talk about 4 rate cuts this year. So oh, it's down from previous projections, but clearly how they going to cut rates with 4.366%? The market is screaming a different tune. This is inflation. What was it? Forward-looking inflation projections are up with energy and commodity prices, and you can't. Can they cut rates with that kind of in that backdrop? No, that's exactly what Powell is fighting. He's like, that's a temporary backdrop, um, and that's the whole rate cut, rate hike type of conversation, which is such a downstream, second order effect type of conversation. But the fact that this kind of headline comes out, that there's still rate cuts on the table, considering energy and commodity prices and having this inflationary pressure like this historic inflationary pressure, completely uncertain what's going to happen with energy prices over the next 6 months to a year. The disruption hasn't even really hit the system. You know, the energy producers were bottlenecked, so they had to cut production, and the storage of produced energy was just completely filled. So all that shit takes time to unclog and settle down. And by the time that settles down, now all of a sudden you have all these producers that cut production, which takes another 3 months, a quarter of a year to ramp back up. It just so so much of these headlines are such bullshit. It reminds me over and over again. And I forget who said it at the Fed. It was probably one of the old chairs. Um, it's it's all jawboning. So all of this rhetoric we hear from the administration, especially from Fed governors, it's all their words affecting the market, and that's just such an important thing to recognize when reading headlines. Like we just talked for 30 minutes. I read one headline. The entire conversation that I just had about global macroeconomics, about energy pricing and the war was based on three charts: the DXY move and the 10-year. We didn't even have to look at headlines to infer and not even guess, but basically not pontificate, but uh, interpret what the headlines are. I guarantee you, if you look at all the headlines, you probably relate back to the entire 30-minute opening of this conversation, in some way, shape, or form, because it all comes down to the relative pricing of money, the relative pricing of currency, the relative volatility of money, and the relative volatility of currency. That's that. Welcome, everyone. Not bad. 22 cents, give or take, on curve. Disappointing pricing. Great. All right. What are we supposed to say? Are we supposed to be excited about pricing on a Monday after a move blow up like that? Yield basis was up 4%. Arrow 14%. It was up at 18 or maybe 20% a little earlier today. There's no explanation for this other than the one chart that I think is quite interesting. Two charts. This one, this is Global Central Bank balance sheets, dollar denominated. And notice how it has a nice bounce off of the monthly 100. But watch what happens. Watch what happens when you go in on the weekly. Look at this structure. So we were below the not only the 50, the 10, but the 100. But look at the breakout above the 100 and basically a retest to the 100. Breakout, retest, and now we're in this orange circle. Look at others Bitcoin denominated. It's just such a remarkable structural similarity to the weekly 50. Below the weekly 50 for all this time, obviously some spikes through, but now you have this breakout and this retest of the weekly 50. So breakout, retest. Look at the orange circle. I wish I can't. I don't have it set up where I could put the two charts right now, but breakout, retest. Look at that. Oh, breakout, retest. Breakout, retest. It's absolutely remarkable, and I think that is very clear correlation. Um, that and others significance of Bitcoin denominated. Let's take a look at others without. Yeah, so you don't get this. It's interesting that it's Bitcoin denominated. I'd have to think about that. The significance of why Bitcoin denominated non-Bitcoin pricing correlates so well to central bank balance sheets, dollar denominated. But I find that absolutely extraordinary. Look at that orange circle. And look at that orange circle. Breakout retest. Absolutely remarkable. Um, Bitcoin dominance. We thought it was going to push through last week and it rejected. with a bearish engulfing. To me, that was unexpected. I thought Bitcoin would break through. I think that's probably what Ben would think also. But it was rejected with a bearish engulfing, and now 6 days, 8 hours. Let's see what it does this week. It's not the current candle that's the most important. It's always the follow-up candles that are most important. But thus far, we are still in a below a rejected retest of the weekly 100 territory. That is certainly constructive to say the least. Bitcoin dominance without um, without stable coins still has the rolling top presentation. Um, so from a crypto space perspective, it reminds me of like a DXY reality. So we have this complete uncertainty for the past year. Nobody knows which way this thing's going to break. That's basically what Bitcoin dominance is telling us. Say, all right, we push below the weekly 100. We're about to see finally some outperformance of the non-Bitcoin space. Um, but it's hovering just below. So it retested. We don't know if it's going to break lower or it's a failed breakdown and it's going to push back above the weekly 100 moving average. Complete uncertainty is where everything is at, and it's going back and forth. And that is a complete manifestation of volatility, uncertainty. Nobody knows. So that's what we see in money, that's what we see in currency, and that's what we see in the pricing of of risk assets. Complete uncertainty. We also see that just in the boring dollar-denominated Bitcoin price, where Bitcoin regressed to the more or less the candle body closes of the 2021 highs. So the highs back here, and we had the entire 2020 or more or less it was a zone of congestion. Like, what the hell is it going to do? We had the big breakout and a complete retest. So this still remains a, a bullish biased chart, dollar denominated. Congestion, breakout of a previous resistance, retest of a previous resistance. So this stuff is clearly taking years to play out, dollar denominated, and that's okay. I'm not too worried about the time duration. But this definitely has a bullish bias because breakout, retest, and now you want the higher high. That, ladies and gentlemen, is what I've classically defined as the trifecta of bullish confluence: breakout, retest, higher high. At least Ethereum is above 2,000. Talk about volatility. Nothing really to take away from this chart. It just screams volatility. So it has less stability, volatility. And because of this volatility, this plays into how I categorize it and treat it from a portfolio management perspective. Doesn't really fit the bill for cash, in my opinion. Therefore, I don't treat it as a cash, at least Bitcoin for me. I treat it as a cash. It has served well as a cash and continues to be effective as that. Nothing more, nothing less. So, in so many regards, I marginalize the significance of Bitcoin and Ethereum. While I still wholeheartedly appreciate the overarching Bitcoin maximalist narrative, hard money and stuff like that. I love that stuff, but from a portfolio management perspective, that's just a narrative, and it serves as a cash component. Cash being Bitcoin as well as stable coins. Ladies and gentlemen, if you're on X or on YouTube, please feel welcome to ask any questions. More than happy to talk about anything. I think we've done the rundown on technical data. Nothing else stands out to me. Man, I do love looking at the central bank balance sheet. I find it quite intriguing, especially from a monthly perspective, that it never, ever, ever, ever breached the monthly 100 from a moving average standpoint. That's just a technical reality. Now, folks will say lines on a chart. That's what they always say about technicals. But that's real. It's real that it never punched the 100 SMA. It just didn't. So therefore, might be a line on the chart, but that Line sure as hell tells a story enough to have an entire conversation about it. The fact that another interesting observation on this chart is that we've never ever interacted with the 100 SMA, at least in a post 2008 global financial world, which means one thing since post 2008 is a very unique financial world compared to prior to 2008, just like a post 2020 financial world is a very different world compared to prior to 2020. It means that um, it's quite unique. That means you have to appreciate that central banks are playing a more significant role in basically the volatility of money and the volatility of currency. And this is like Raoul's type of narrative, where you have that very tight correlation between equity pricing and the amount of assets that the central bank owns. And they couldn't go lower. They simply couldn't go lower than this moving average. Now, he looks at the correlation between like NASDAQ, S&P, so on and so forth, but this is just a correlation with a moving average. That's pretty interesting. Not that it's different, it's just an observation that's real. So, for whatever reason, the central banks needed to respect this average for whatever reason. I don't necessarily have an answer for that other than the reality that this is what they did. And this is years here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 13, 14, 15, 16. So that's 16 months of trying to interact with the 100 SMA, and it didn't breach it. Every time it just punched right back up. This is a fascinating perspective to say the least. And then we obviously have that tight correlation on the weekly 100 with others Bitcoin denominated. That's my other interesting takeaway for today that I continue to monitor and observe. Sports Canada, present cap, much a pleasure. Always a pleasure. This has become an atypical stream on a Monday. I have been doing one stream a week, but I figured since the volatility of money blew up on Friday, I might as well talk about it on a Monday. Frog, Froctopus, always a pleasure. Cat, big props. You're a shred. I'm getting there. I'm not where I want to be, but we'll see. Definitely keeping it up. How does PayPal benefit from having the stablecoin on Curve? Is the company using PayPal or the users or PayPal? It's not that PayPal would benefit, it's that so we've discussed a reality that most people don't. I talk about the cryptocurrency space as an emerging market. Emerging market of emerging markets is a thrown around terminology. Um, so if it's an emerging market, it's not about PayPal in terms of traditional finance or using it at terminals necessarily or online merchants and shopping. It's people that have and use their currency, PYUSD, from an Ethereum mainnet perspective. So if and when probably Ethereum mainnet becomes more tightly integrated with standard financial systems, the only way for the PYUSD to actually have a value of $1 is for it to be managed from a liquidity standpoint in this emerging market such that it has a value of $1. That's the most fascinating thing about stablecoin. Stablecoin does not inherently have a price of $1. And that's what most don't understand. When you go to and that's what the peg keepers, that's what Frax and CRVUSD have done so well with their peg keepers. Um, for a stablecoin to have a value of $1, you need to be able to spend $1 worth of USDC or USDT, USDT.0, or whatever. Pick a stablecoin to purchase $1 of the PYUSD. And you need it to be able to use one PYUSD to purchase one USDC. A stablecoin having a value of $1 means it can be bought for $1 in another currency, and sold for $1 of another currency. So that's why liquidity is so critical. And the liquidity is a fancy word that means the pools and the balance of the pools, the actual balance. That means all the pools. So if you have one pool out of balance, it plays into the entire system. And we're still in an ascent period of the entire cryptocurrency space where we still get pool instability. But man, now with the peg keepers and what Curve and Frax have built, we have at least the fundamental components of a system that is technologically required in order for stablecoins to actually have a value of $1. It was just a few short years ago that we went through an explosion of stablecoin products and so many failures of stablecoins, and that's all. The failures are a manifestation of the reality that if you lose peg in one pool, even though there's like 10 different pairings, it throws off the pricing and there's ripple effects and there's potential exploits depending on the infinite combinations of code. So the stability, the relative value, or the relative liquidity depth of a stablecoin in all available pools is mission critical for that stablecoin to have a value of $1 in these emerging markets. So how does PayPal benefit from having these stablecoins on Curve? Because Curve is offers from a pool, an LP, the contracts that control these pools give the tools, give the best tools right now available for stablecoin issuers to manage their currency to have a value of $1. So there's two ways a currency is, well, three ways. One, organic. So there's arbitrage and opportunities. And when you have the incentive structure that Frax and Curve offer, that gives stablecoin issuers a capacity to influence the liquidity depth in these LPs. So there's organic. There's inorganic, where the stablecoin issuer can do open market operations, which is pretty much how USDC and USDT operate. I mean, they're centralized stablecoin issuers. I have no doubt that they execute open market operations in order to manage the relative pricing of their currency. And then there's the third one, which is the most interesting, which is the automated management, and that's the peg keepers. So because if you're an on-chain native stablecoin like CRVUSD and Frax, you have a capacity to print currency into an LP. So there's two ways, primary ways to manage the pricing of a stablecoin. If so, let's say your stablecoin is 99 cents or 98 cents or DPEG 97, so on and so forth. If it's below $1, you need to incentivize the market to buy the stablecoin. Because if you incentivize the market to buy something, that's going to increase the price of what's being bought. So 97-cent stablecoin, and you get the market to buy it, it goes up in price. So how do you do that? You do that with interest rates. So because these stable coins are created by people, by basically the Eurodollar market on chain, these stable coins in existence are created when people borrow against collateral. If you increase the interest rates on that collateral, you're effectively encouraging people to sell their collateral to buy the underlying stablecoin, or rather, um, or or buy the stable coin in order to pay back some of the debt against the collateral to stabilize the collateralized debt position. That's why they're called CDP stable coins. So that's how you manage a stable coin being below $1. When a stable coin is above $1, that's very easy to manage. If your stable coin is $1.01, you need to increase the supply of stable coins in the LPs, in the pools. And if you have peg keepers, all you do is print currency. You print the stable coin and you put it into the LP, and that will balance the LP and decrease the relative pricing of the stablecoin. So managing the price of a stablecoin that's above $1 is obviously infinitely easier than managing the price when it's below $1 because you can just print it. That's the beauty of an on-chain native CDP stablecoin. Um, so it's not that it directly benefits PayPal; it's that this is a potential market. And as this market grows, in which case this market is pretty much stale right now, this market it's not just volatile, it's everything we've talked about over the years with regard to Ethereum as an emerging market is still the case, but it's so nascent, it's just barely getting off the ground. The potential is everything we still have discussed, where it's integrated into everything and it becomes the backbone of financials. But I mean, but nobody, most people don't even use PayPal. It's big. Most people don't even use it. Most people don't use Venmo. You know how many people still use checks and debit cards and not even credit? Not that credit's necessarily better than debit. That's an entire financial conversation. But the point is, this emerging market is barely an emerging market. And that's such a contrarian take, which is ironic because most will look at the cryptocurrency space and say, oh, we had our cycle between 2020 and 2021, and 2022, it was a bear market. No, there's no bear market. This is just a market. The important time period to respect is pre and post 2020. This entire market didn't exist prior to 2020. But now there's a financial market that issues its own liabilities, that has credit products and services, that has foreign exchange venues, that has endless B2B, business to business products and services, and frankly, endless B2C, business to consumer products and services. But it's only been 6 years. So this emerging market is barely a brand new financial market. Now, if you think about that in terms of a traditional emerging market, Brazil, India, I don't know, pick a relatively large sized emerging market, they're infinitely more sophisticated and robust. And it's not just that they involve traditional banks or whatever you want to use to differentiate this crypto emerging market as compared to a traditional emerging market. The reality is that's all it is. Yeah, all you have is a comparison. What are the components? What are the features? Who are the users? And in that regard, Ethereum is literally just a very early, small scale, nascent emerging market that has almost all the fintech products and services of any financial system. What's the main difference? The difference is that the crypto emerging market is this emerging market of emerging markets. So it's like an emerging market squared. It's an emerging market that's accessible to all markets around the world directly. So it's not like if you're in Southeast Asia and you want to interact with a US market, you got to go through maybe someone in England. I don't know. Or you got to use an intermediary. Everyone around the world technically can directly interface with this emerging market, Ethereum as an emerging market. So there's no need necessarily for intermediaries. So that is what really changes the equation. The potential or the reality that this emerging market has collapsed all requirements whatsoever for intermediary uh, access. It's just not needed. So that's unprecedented. Anyhow. Endless conversation. Good point, though. Uncertainty makes rule number four important during these times. Rule number four, ladies and gentlemen, never fuck up the cash position. This year, along with in many regards years past, is it remains survive because you're going to have, in my opinion, the appropriate capital management methodology is the four rules. Rule number one is own more assets. But if you're owning more assets that are volatile like this, you have assets you bought in 2022, 23, 24, 25 that are probably significantly depreciated at this point. Now, this isn't a trader's conversation, ladies and gentlemen. A trader would say you should have sold it a long time ago, but this is rule number one, own more assets. I didn't say anything about selling. So what you have are assets that have significantly depreciated and deflated. So as long as you have cash on hand from the revenue your assets produce, you can balance the books, you can pay your bills, so on and so forth. And you don't have to sell your assets. So what has deflated, what has depreciated, will reinflate. It goes back up in price. And we don't have conversations, ladies and gentlemen, about meme coins and bullshit like that. We're an investment type of conversation. So we're talking about what are the businesses of the crypto space? What are the B2B, B2C, what are the fintech businesses, the five businesses of crypto, foreign exchange, credit, derivatives, liability printing, and liquidity financing? What are the businesses that survived? Because was it Friday's stream that I talked about the comparison to the dot com bubble? So what's pertinent is what survived. So if you own any of the businesses that survived 2022, a liquidity crisis and a collapse of this emerging market, your comparison is what are the Amazons? What are the Microsofts? So what deflates reinflates. And what are the Amazons and Microsofts will reinflate to a very different level than they were at when they were at their highs, because this market is barely scratching the surface of even being able to be defined as an emerging market. It's microscopic. So when this market becomes what it's destined to become, what has what has created this deflationary state in asset pricing not only will cure the relative deflation that people have experienced, you'll have your bubble. You'll have your traditional crypto bubble. And those prices get really weird. So my 2 cents is the four rules. So as long as over the last 4 years and you continue into the future, rule number one, own more assets. Rule number two, don't buy assets at a bad price, which means you want to buy assets when they're cheap, discounted. Rule number three, make sure your assets pay you. Rule number three, fuck you, pay me. That's the qualification for an asset that contributes to a functional investment portfolio. Because if your assets are paying you, you have revenue. You have revenues, you have receipts. That's a whole nother conversation about accounting. That's another story. But if you have receipts, in good times you have prosperity. In bad times you have austerity. And then as long as you respect rule number four, you will survive. Never fuck up the cash position. Never spend more money than you have. Never become a forced seller of your assets, because rule number one is to own more of the assets. Rob, thank you very much. Appreciate that. Definitely. B. Snoot. Since we're on the topic of stablecoins, I have a question about the future adaptability of the cryptocurrency space migrates to post-quantum secure cryptography. Any ideas how stablecoin providers manage the transition to post-quantum secure chains as they go through the migration? Well, we're primarily talking about consensus algorithms as well as anything mission critical in low-level Ethereum and Bitcoin implementations. I think there's no need to be uh, much thought at all from a consumer standpoint. If you have a migration in Ethereum implementation, you're talking about soft and hard forks, in which case Ethereum has shown that it can pivot not just quickly, they have pivoted very seamlessly and smoothly through both soft and hard forks. Bitcoin's been a little bit more contentious through soft and hard forks. The direction of the chain has been a little bit more rigid, but I expect the same to play out for both chains. If there's especially, it's the same thing as government intervention. If there's something mission critical, all the powers that be will come together and have consensus on that something has to be done and something will be done. So if there's ever a crisis, I expect Bitcoin to pivot just as fast as Ethereum. That's my general expectation. Post quantum, there's always a debate on how soon that is. I don't give it too much thought because that's much more low level in the blockchain space than I tend to operate. I'm more from an investor level. But clearly, from my software expertise, I do understand and appreciate the implementations. But I have no doubt from a coding implementation perspective, it's what I said is the case. If forced to pivot, everyone will pivot really quick, and the nodes will op up the will node operators will vote by upgrading to one implementation or another, and consensus will be reached, and the blockchains will continue to produce blocks, you know, in whatever is the chosen mechanic, because that's how a soft and hard upgrade works. No different on Bitcoin versus Ethereum. And obviously, you have an endless conversation about consensus and who owns what with regard to Bitcoin versus proof of work and Ethereum proof of stake node operators. But in the end, consensus is still consensus. The node operators achieve consensus by choice of upgrade. Um, so it's identical. As much as it's so different, is the type of consensus that the two chains operate on. It's the fact that there is consensus is completely identical. That's not too much to think about from an investor standpoint. Crisis will pull everyone together. It always does. Sports Canada, my man. Love that breakdown. You are my go-to mentor. We'll meet one day. I'm always around. I'm also finding it hard not to trade to make money. I got the four rules and they are the purest. There's nothing wrong with trading. Um, I have some family that really wants to trade, and I know how to trade. It's work, and I don't want to work. I do enough work with my job. So in order to trade, it's the same thing that I've done with my rules. You follow rigid rules. Do this, X, Y, and Z under circumstance A, B, and C to produce outcome, D, E, and F. So you just need to define your conditions. Once you define your conditions, as you maybe do some regression testing if you want to validate that I mean, you don't even need to do regression testing. It's just validate that your conditions are effective. Maybe just some sample with mock money and mock accounts. And once your conditions are effective, you just duplicate those conditions. But it's the same thing with the four rules. You must adhere to those conditions independent of emotional state. If a position dictates that you enter, you enter. If you exit, if it dictates you exit, you exit, and you can't have any bias whatsoever. Which the reality is for trading means human beings are not optimal for trading. It means the best trader will always be a computer because there'll be no bias. So probably the best exercise for someone who wants to get into trading isn't to directly trade, but it's to use AI to generate algorithms and integrate those into, you know, just a simple Python script, or you could get more sophisticated if you want, and you hook up the APIs to a trading platform, and you have your algorithms execute trades under very rigid, specific conditions. Enter, exit, position type, never neglect the stop loss, and protect the capital. All you need to do is win 51% of the time. That's a very standard statistical perspective. And as long as you do, your gross trading, the overall outcome will be positive and up and to the right. To each their own. My bias for the last years has been from an optimized accounting standpoint, and there is almost no way to optimize accounting for capital gains and trading. On the other hand, there's plenty of ways to optimize from ownership and structures and business structures and from an unrealized property perspective. So avoid realization and like for instance, I have and will continue to execute not on a net worth perspective, but on a I don't care about time perspective. I care about correctness. For instance, if here's just a very general statement. If a portfolio goes 100x on the money and crashes 95%, it's had 5x on the money. If the portfolio then goes 100x on the money, that's 500x the original investment. If it crashes 90% on the money, okay, that's up, down, up, down. And if that occurs over a 10-year period and you end that 10-year period, let's say 100x on the money, but you made revenue the entire time and you own what was the survivors of the crypto.com bubble, the next Microsoft and Amazon, then anything that happened in between, any of the ups and downs doesn't matter because then you're not up 100x. Your first one may maybe drive you nuts because you're up 100x and you're like, and then you crash 95%. But the next one goes up 1000x and it crashes 90%. But then the next one after this is an established market. It's an established market emerging from an emerging market. That's not up 100x. That's not up 1000x. That's up 50,000x. That's when something goes from $1 billion market cap to $200 billion or $500 billion. Or by that time, global money has a different depth and it's worth $1 trillion, $1.5 trillion, $2 trillion. I mean, a few short years ago to say Microsoft and Tesla would have $1 trillion market caps was insane. But now we have stocks in the equity markets that are running around at a trillion plus, a couple trillion. And these are obviously like Mag 7, but look, you got Mag 7. Think about top 10 crypto. Top 10 crypto in 2020 were very different than the top 10 in 2016, 17. Were very different than 2013, 2014. So the top 10 in equities, think of the top 10 list. Top 10 list tends to be multiples or a magnitude larger as the system expands. Now, obviously, the equities markets, you're not going to go from a trillion to 100 trillion. So that gets kind of weird to think in those terms because it's already an emerging market. But when you got these relative small numbers in crypto, that's the most important takeaway. I mean, the market caps on these companies in crypto are so relatively microscopic. By the time they get to mid cap or large cap US equity size, you're talking about 100x on the money, 200, 300x on the money. And that's not even to the Mag 7 size, to the big names. And that's really where the destiny of a lot of the crypto space is. The scale and the scope of these crypto markets isn't Mag 7. The scale and the scope of these companies in the crypto markets are beyond what a US equity company is capable of. Because a US equity, the largest companies in the world, have a manufacturing facility in many places. They sell products in many places, but they're still constrained by borders or logistics or supply and inventory. But the scale and the scope of these fintech banking products in the crypto markets are a whole nother level. That's the biggest takeaway. We're talking about money and currency. These are the biggest businesses on the planet. So the scale and the scope of these crypto businesses are monumental as compared to talking about the scale and the scope of an Amazon or a Microsoft. You're talking about banks, central banks. Whew, gives me chills thinking about how big these companies could potentially be as this emerging market becomes a market. And what happens? It's a what if. There's no doubt that this emerging market becomes a market. The interesting and the tingly thought is what happens when this market becomes what it's destined to be. How big is it? So, as I said, this is a market that's accessible to all markets directly without intermediary. That has never existed before. There's always an intermediary. But in crypto, you no longer have the need for an intermediary. It disintermediates the entire financial landscape. So the potential scale and scope of crypto is unprecedented. We have no idea where it's heading. So that's why I always come back to people and I'm like, I don't give a shit about the volatility. I don't care. I just want to own a small piece of whatever the hell this is becoming. And I don't care how long it takes because if I own it, I'm going to own it and it's going to become what it's going to become. I just need to wait for it to become what it's going to become. So that's why I came up with the four rules. Just own more assets. Over time, own more assets. And you're guaranteed to own assets that are part of whatever the hell this is becoming. Simple equation. You just need to survive. Until then, thus, rule number four. Thank you all for joining me. About an hour and 10 minutes today. Not a bad stream. We started with the volatility of money. We ended with our ever tantalizing thoughts of the scale and the scope of the potential for these markets. Monday, March 23rd, 12:41 p.m. 151 people made it to the end of the stream and are all now that much more rational because of it. I appreciate you all. It's always a good conversation. Stay calm, cool, and collected throughout the week. Watch the volatility of money, watch the volatility of currency, and we'll have another conversation on Friday. Until then, peace.